Welcome to Real Estate 360, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back. Welcome to the program today. Thanks for tuning in to Real Estate 360 program, your number one source for all of your real estate needs and education. We're broadcasting from the number one business radio station in the San Francisco Bay Area, KDOW-AM 1220, the Wall Street Business Network. I'm Tom Wilson, your host for the Wednesday edition of Real Estate 360 that comes to you daily Monday through Friday at 3 p.m. along with my co-hosts Joe Kuchera and Laurie Graymont. If you can't make the live show, you can catch our podcast on RE360radio.com, and you can catch my programs on TomWilsonProperties.com or on iTunes. You can go to my website, TomWilsonProperties.com, and get a weekly economic newsletter that gives you a nice 1-minute read summary of all that's going on in the world of economics as it applies to real estate. You can also request a white paper on how to go about selecting the best metro and product to invest in. So you can get either of those from TomWilsonProperties.com. Well, we have with us today special guest Ron Ricard, who's a specialist in 1031 exchange. And for those of you who don't know what that's about and you are considering investing or already invested in real estate, it's critical that you know. And if you already know something about real estate exchanges, you're guaranteed to learn more today. And we will also have Ron back next week and continue more on the topic because there are so many aspects of it. 1031 exchange in concept is simple, but as anything that the government gets involved with, and it can get very complex. Ron is designated as a certified exchange specialist, one of fewer than 160 people nationwide who's earned that certification, as accredited by the Federation of Exchange Accommodators. He's taught 1031 tax exchange accredited courses to over 15,000 investors, real estate agents, accountants, and attorneys all over the country over the past 12 years. Ron's a frequent guest on many programs. He's a guest lecturer in many different places, and he's on a 3-year term on the board of directors for Santa Clara County Association of Realtors and is very active in numerous real estate associations throughout Northern Cal. Ron is another engineer turn into the real estate business. There's something about us analytical guys that tends to lend us going that way. Ron, nice to have you with us today. Welcome to the program, and tell us how you went from engineer to involved in real estate and 1031 exchange expert.
Well, thanks for having me, Tom. Yeah, when I got out of school at Berkeley, go Bears, I had a chance to start in the utility business, worked for PG&E for a few years, and then worked for other companies within energy management. And when that market kind of crashed in the early 2000s, I needed a career change, and this popped along, and I've been doing this almost 12 years now and loving it.
Oh, boy, you've like many different businesses, wow, have you ever seen some crazy cycles here since you've been in this business? Huh? Little did you know what was coming up.
Absolutely. It's funny because I remember when Enron crashed and PG&E was having troubles, and I thought to myself, my gosh, that's the end of the energy business as we know it. Come into real estate, and real estate goes from 0 to 100 miles per hour, then back down to 0 and backing up for a while there. And so, yeah, it's a heck of a roller coaster.
Yeah, and you got in, so 12 years ago, it'd be what, 2001 or so. So we were seeing the dot-com crash, which in a normal market should have said that the brakes would have gone on real estate, but these subsidized interest rates just allowed us to mask that whole normal cycle pressure, and things just went up, and exchanges became extremely popular from about then till 2005 or 6?
Yeah, the market really started to take off around 2004. 4, 5, 6, and into 2007. We started seeing a slowdown in 2007. But for those 4 years, the number of transactions we did was more than double a normal market, and it was pretty crazy there for a while.
Yep. Well, before we get too much farther along in this, for those that are kind of new to exchanges, let's define for folks what it is and why they do them.
No problem. Yeah, 1031 just refers to a section of the IRS tax code. It's a section of the tax code that says that you can have an asset that you use for business or investment. And when you want to sell that, you can buy what's referred to as a like-kind asset. And by following the rules, you get to defer paying taxes on the profit that you made. In other words, you have a house. It's a rental house. You've been renting it for the last 20 years. You want to sell that and go buy a duplex. So by following the rules of 1031, you sell the house, you buy the duplex, and because you went through the process of the 1031, which partly means using an accommodator, then you get to defer paying taxes on the capital gain, the depreciation recapture, all the money that you would have given to the government. You don't have to.
And in fact, if you stay in real estate for the rest of your life, you never do have to pay capital gains on it.
Exactly. In our industry, there's a term we use called swap till you drop. You just keep exchanging, and hopefully you never have to pay the government.
And then your heirs don't have to pay for it either, right? Because when you die and pass it on, then the cost basis goes up.
You get a full step up in tax basis. Actually, if you do it right, maybe even the death of one spouse can give the surviving spouse a step up in basis. So, hopefully it's something that allows you to avoid the taxes not only your entire life, but your heirs never have to pay it either.
Yet another reason why those of us who love real estate love real estate.
Absolutely. That's the problem with stocks. When you sell a stock to buy another stock, you got to pay taxes every time, but not on real estate.
Tell us what like-kind means.
Okay, like-kind is a very confusing term, but it's really, really simple when it comes to real estate. All real estate is like-kind with all other real estate. As long as what you are selling and what you're buying is real estate that's used for business or investment, it can be exchanged for any other kind of real estate for business or investment. So,
basically anything other than your primary residence, right?
Well, there are a couple of things. For example, definitely your primary residence is not investment real estate, though in some cases it can be dual. Let's say you live in a duplex where you live in one side, rent out the other, but we can get into that later.
And even though many people in California think that their home is an investment, right?
The problem is you got to live somewhere. So I never think of it as your primary residence as an investment. And for 1031 purposes, it definitely is not.
Robert Kiyosaki pounded that one in pretty hard, starting with Rich Dad Poor Dad, didn't he?
Absolutely. That's where I learned that line. Second homes, that little place you like to go to on weekends. That's not investment either. The developments, flipping. That's thing that a lot of people don't realize is that when you're buying a property, fixing it up, putting it back on the market, that's not considered to be investment real estate either. That's considered by the IRS to be a job, so it's not qualified for 1031 as well. That right now is, I get a lot of people asking about flipping property, but that's something that does not qualify. Yeah,
we'll get a little bit more into that a little bit later, because there are a lot of folks here in our high-end cities that love flipping and trying to jump on the bandwagon, and they need to understand the tax consequences of that.
Exactly, yes.
So like-kind applies to other business investments too, right? But if it's not real estate, you can give some examples so people understand that this 1031 doesn't just apply to real estate, but for those of us that are real estate investors, that's mostly all we care about. But if you have an airplane, you can.
I've done exchanges on airplanes. It's essentially for any real asset. So you cannot do exchanges on stocks or bonds or partnership interests or anything like that. But I've done exchanges for airplanes, and obviously, what's like-kind with an airplane? Another airplane.
And rough interpretation of real is tangible, hard.
That's what I would consider. Yeah, exactly. It's not paper. So farm equipment. I've done exchanges for people who've sold hotels. They sell a hotel to buy a hotel. There's an exchange not only for the hotel, it's for the real estate of the hotel, but the equipment within the hotel. And so there's even when I talk in the Central Valley, I make a point of talking about livestock. If you want to sell a horse, you have to buy another horse. That's to be like-kind. It has to be the same sex too. A male horse is not like kind with a female horse. A dairy cow is not like kind with beef cattle. But so there are some restrictions on that. But yes, assets can also be exchanged, definitely.
So let's get back to what happened to this cycle. As things were booming, and that meant that people had a lot of equity, and they wanted to go leverage that and expand on it, so they were doing a lot of exchanges. And then the crash happened in '08. So what happened to the exchange business? It didn't by chance crash also, did it?
Oh, it made whatever happened to the real estate market, it times that by about 10. That's what happened to the exchange market. The number of exchanges dropped by, depending on where you were in the country, between 80 and 90%, and in Northern California, it probably dropped more than 90%. Essentially, 1031 is what you do when you've made money on a property, and for a lot of people, when the market crashed, they lost their money. They lost that. They lost that the profit that they made, and especially if you were in a market that went down 40, 50, 60, 80% in some cases, you had no gain in those properties when you sold them. So
there was no equity left to exchange into something. Right?
Exactly. Not only no equity, no profit to exchange either. So because of that, the number of exchanges that we did dwindled to, like I said, over 90%. Consequently, though, we had about 4 pretty rough years. Last year, we started to see a pickup in the market as real estate started to recover, and this year we've seen a substantial recovery. We're not quite back to a normal time yet, but definitely things have improved.
I think before the program, you and I were chatting. You said you think we're kind of back to 75% of normal times.
I would say, yeah. If I look at when I started, what the market was like in 2002, 2003, compared to where we are now, we're not quite back to a normal market, but compared to what we did from 2008 to 2011 to 2011, definitely a lot stronger market, and the number of people doing exchanges is definitely much more than we've seen during that time.
And relative to the peak, I think you said we're back to probably about 40% of the peak.
Yeah, that sounds about right. That sounds about right. Yeah.
Mm-hmm. Okay. So we've seen amazing cycle here in business. And how many accommodators did we lose? Probably the same percentage of accommodators during that time period?
I would say probably 60 to 80% of the companies who acted as intermediaries, accommodators, facilitators, whatever you want to call us, went out of business during that time. And the reality is for us, it's a volume business. We don't charge a lot to do exchanges. And so when the volume went down, most of them said it's not worth it anymore. They found something else to do.
Well, Ron, that's a good start for everyone. Ron's with Investment Property Exchange Services, IPX 1031, and he's an expert in 1031 exchanges. So we're learning about that, and we're going to get into more unique aspects of it here when we get back, including forward versus reverse. This is Tom Wilson. Will be back with us in just a minute.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. We have special guests with us today, Ron Ricard with IPX 1031 Exchange Services. Ron's an expert in that area. He's another engineer turned to real estate. He has a civil engineering degree, MBA, been in the corporate world for many years, and with PG&E and others. And he went over to the 1031 exchange business in 2001, and has been there ever since, and has spent a lot of time learning and teaching about the topic and keeping up with all the changes which happen periodically. Ron, talk to us about forward versus reverse exchange.
Normal exchanges, about 99% of all 1031s, is you sell something, then you buy something. Now, there are time limits when you do an exchange that are very important, and I'll go over those now for you if it's okay. When you sell the property, you have 45 days to identify what you're going to purchase and 180 days to actually buy it. So in other words, you have 6 months to complete your transaction, though you need to know what you're going to buy during the 45 days. And whether you buy you can buy the replacement property 1 minute after you sell yours, or the day later, or whatever. That's called a forward exchange. The money goes from one property into the other. Title goes from one property into the other. Occasionally, you'll get into a situation, though, where you have to buy the replacement property first. And in today's market, that we've been seeing a lot of people do that.
So explain why people would want to do in a reverse.
In today's market, there's such a lack of inventory, especially the market we just came out of, that people were more concerned about finding their replacement property. They figure they can sell theirs anytime, so they go into contract to buy a property. In today's market, the sellers don't want to wait, so they have to close escrow within their 30 or 45 days. Meantime, they put theirs up on the market, but now they're in a situation where they have to close escrow on what they want to buy before they close escrow on what they want to sell. The main thing to know about these is, one, you have to have the money to go buy that other property.
Yeah, for our regular listeners, I've done about 20 exchanges. 2 of them were reverse, and it was a good thing I did it that way. But yes, ouch! You got to be prepared to put up that money.
Yeah,
a couple of them I did were large multi-fam properties, and we're talking some sizable bucks. But I knew what I wanted to replace was going to be very hard to find, so you had to find that first.
Oh, no, exactly. And actually, and depending on the kind of property, if you're buying residential real estate, lenders don't like to participate very well when it comes to reverse exchange either. Commercial real estate, usually you can get there's a little more leeway in there, but the main thing to realize also is the fees for doing this kind of exchange are not just a few $100s, they're going to be a few $1,000s, because as the intermediary, we actually need to take title to the property for you, not just control the funds between the transactions. So much more expensive to do, requires you to have the capital on hand. Again, we try to avoid it. We try to avoid it whenever possible. So most exchanges are forward exchanges.
And does IPX 1031 Exchange Services do you do reverse?
Yeah, we do. We have a team of attorneys in our Arizona office, and they do our reverse exchanges nationwide. We don't our regular exchanges. We have offices throughout the country, but reverse exchanges, they're very specialized, and we only let the attorneys work on those because we don't want to we want the consistency of make sure that it's done right, because the IRS has very strict guidelines on how to do reverse exchanges, so we want to make sure we follow those correctly.
So tell our listeners just rough numbers. What's a typical forward exchange, a simple one property exchange cost? What are the accommodator fees, and then what is it ballpark for a reverse?
Well, a regular exchange is probably going to cost you around $850. Whereas a reverse exchange, you're probably looking at around $5,000 plus the cost of an extra escrow. And if the property that you're having to purchase is in a place like San Francisco or Oakland that has very high transfer taxes, that number can end up being much higher in terms of how much it's going to cost you, because you do have to go through an extra escrow when you're doing a reverse exchange.
So if you're dealing with something in Dallas-Fort Worth that's a $100K property, then you got to consider if that makes sense or not. But if you're doing a California high-end city property, or you're doing a multifam or something, then those fees are pretty minor compared to the tax advantage that you get from doing that reverse exchange.
You always want to look at make sure you're saving enough money to make it worth that extra expense. Absolutely.
Mm-hmm. Okay. Thank you, Ron. We'll be back in just a moment. We'll talk more about different kinds of exchanges and boot money and things like that. We have Ron Ricard with us today, expert with IPX 1031 Exchange Services, and we're talking about that whole business. And there's a lot more to learn, so be back with us in a minute. This is KDOW.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. We have special guest with us in the studio today, Ron Ricard with IPX 1031 Exchange Services, an expert in that field, teacher, and someone who's been through several cycles of this whole exchange business, and it's relatively hot again, isn't it, Ron?
Absolutely, yes.
Yeah, and for good reason. A lot of money to be saved. Give us, if you will, some concepts about what this boot money is all about. A lot of people have heard about boot money, but they don't really understand what it is. Well,
the thing to remember in a 1031 exchange is that you need to reinvest everything. A lot of people think you just have to reinvest your profit. That is not correct. So if you sell a property for $1 million, then you want to buy $1 million. Now, you can subtract the escrow fees, title fees, but for the most part, whatever you sell your property for, all of that needs to go into the replacement property. Now, if you buy property equal or greater in value, the other part of it is all of the cash, all of the equity that you net after you pay the lender and everybody, the cash that comes out, all of that cash has to go into the replacement property also. Any cash that comes back to you, any cash that you don't reinvest, you pay tax on. That's referred to as boot. So when you do an exchange, you don't have to buy a property of greater value. However, if you want to defer your entire tax obligation, defer all of your taxes, then yes, you do want to reinvest all of your money and buy property of equal or greater value.
I've found this a common misnomer that people think if they miss the full investing of the money that comes out, that they blow the whole exchange, and that's not the case at all, is it?
Exactly. You're correct. That is not the case. As a matter of fact, it's very frequently, I would say maybe a quarter of our clients plan on not reinvesting, and so they want to keep some of the money up front. They're welcome to do that. One thing to remember in a 1031 exchange is that you don't touch the money. Our role as the intermediary is when the property sells, the money comes to us as the intermediary. Then we put the money into the new escrow. Anytime the client touches or has control over the funds, that's when it becomes taxable. So,
i.e., it blows the whole exchange, right? Do not let a penny of that money come into one of your accounts, right? Or you're done.
Exactly. That's why the exchange needs to be set up prior to escrow closing. But if you want to keep some cash and pay tax on that cash, that's okay. But again, if you don't have to reinvest everything, but if you don't want to pay taxes, then yes, you do want to reinvest everything.
And talk a little bit how that translates to the loan part of it. Yeah.
Okay. I'm an engineer just like you, Tom. So for me, it's A plus B equals C. A is the equity, B is the debt, C is the total purchase price. You want A, your equity, you want to equal or greater in the replacement property. C, your total purchase price, equal or greater in the replacement property. B is the amount of loan. For most people, you get a loan of equal or greater value as well. Though, if you don't want to get another loan, you can replace that loan with money from your own pocket. So you don't have to get another loan in an exchange if you have your own cash out of your own pocket to replace it. But essentially, most people do get a loan of equal or greater value also, so that in total they're buying more property than what they're selling.
And I think that's an important, very important point, that you can pull money out of your pocket to replace that loan.
Exactly. Yeah. You need to replace the loan, but you can replace it with your own money. You can replace it with seller financing. As long as in total you're spending that money, the money can come from any source.
When we come back, we're going to talk about a few examples of exchanges and how they might take different routes. We have with us today Ron Ricard with IPX 1030 Exchange Services, an expert in 1031. And we'll be back with you in a moment on KDOW 1220 AM, the Wall Street Business Network. Hang in there with us after these messages, and we'll have a lot more information for you about 1031 exchanges.
For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360Radio.com. That's RE360Radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. We have Ron Ricard with us today with IPX 1031 Investment and Property Exchange Services. He's been in this business for 12 years, a very popular speaker because he's so knowledgeable about it. And we're very fortunate to have him here today to take some of the questions and complexities out of 1031 exchange. Ron, let's talk a little bit about not putting the cart before the horse. The fact that this is not a tax avoidance deal. It's that I think people forget that 95% of the tax code is written to incentivize the society to invest in and boost the economy in certain ways that the government feels is worthwhile to society, whether or not you agree with each of those sectors or not. But that's really the main purpose, and there's no difference in this exchange business, right? In fact, an exchange business has been around a long time. Since when? Like 1920 something?
1921 is one of the first exceptions to the tax code that allowed people to avoid paying taxes. Now, that may sound like a long time ago, but one thing to remember, we've only had income taxes since 1918. So it was literally one of the very first ways to get around paying taxes.
And at that time, everybody had to show up at the same room and table and slap your paper down on the table, and you swap paper there, and it was there was no delay, right? Yep,
all the way up until around 1979 when the famous court decision happened. Everything had to happen the same day. I still remember my parents in 1975. They bought an apartment building, and they had to sell their house the very same day. And up until the late 70s, that's how all transactions, all 1031 exchanges were done.
And so tell what happened in the famous Starker case.
Well, there was a gentleman. He was a forestry professor up in the Northwest, and he decided to sell his forest land, to a timber company, but he didn't want to buy his property right away. So he said, basically, don't give me the money for it. I'm going to go find a piece of property that I want to buy. You go buy it and give it to me. And so he essentially sold his property one day, bought his replacement property a few months later. IRS said you can't do that. He says, why not? And it ended up in the tax court, and the court decided there's nothing in the 1031 code that said it had to be simultaneous. And so that started what we now call a delayed exchange. And if you talk to people who've been around a while, they still might even call them Starker exchanges, because Starker was the gentleman who had this done. And that court case came out in 1979. By 1984, Congress got on board and did the timelines and amended the tax code so that the rules we have now have essentially been in the tax code since 1984.
Some people worry that, it sounds like it's so much hassle and so difficult to do this exchange thing. I hate working with attorneys and anything that's tax related. I'm just going to pay the tax. Tell folks how simple the language is in a contract when you are relinquishing a property to start the exchange process.
You know, the 1031 process itself is much, much more simple than people think it is. Yes, there can be some complexities depending on what you want to accomplish, but essentially you're selling a piece of real estate and buying a piece of real estate. That's all you're doing. And the only thing that you need to do in preparation is you normally put something in the purchase contract that tells someone you're going to do an exchange. You know, 5 or 6 words is really all you need to put in there that says you're doing an exchange. And then you need to enlist the intermediary before the close of escrow, so that you sign the agreement during the escrow period. At the close of escrow, the money comes to the intermediary. You go find the replacement property. We put the money into the escrow and the property closes. So essentially, you're just selling something and buying something.
And most of the communications and complexity is just the instructions from the accommodator to the title company, and you as the investor don't really have to worry much about that, other than making sure it happens on time, right?
Exactly. As long as you follow the timelines and stuff, most of the hard work is really done by the title company and the exchange company. You know, there, and you don't even have to come to the intermediary. Everything is done through the escrow.
Yep. And so as people say, well, why would anybody that's buying your house be willing to engage in that? And that's because the words say something like the buyer is willing to cooperate with a 1031 exchange at no risk or obligation to the buyer, right?
The transaction has absolutely no impact on the buyer. So when if the seller is doing an exchange, it has no impact either time-wise or financially to the buyer. The only reason that the buyer needs to know that the seller is going to do an exchange is because some of the paperwork that they're going to sign is going to show the intermediary as part of the transaction. And so because the intermediary is part of the transaction, the IRS likes the buyer to acknowledge that it's going to be a part of it.
Just don't want the buyer to be shocked at closing, right?
Exactly, but it has absolutely zero impact on them.
And out of the 20 or so exchanges I've done over the years, I've never had a buyer question it or be worried about it. Just a non-issue. It
is completely a non-issue. I've never had a situation where a buyer's walked out of the transaction and didn't complete it because of it.
Is the 45 days to identify a property, is that kind of a guideline, or is that pretty important?
That's about as written in stone as you can get in the tax code.
It's the 11th Amendment, commandment, right?
Yeah, absolutely. 45 days to identify what you're going to purchase, and that 45-day clock starts at the close of escrow. Now, mind you, also, we'll be talking next week about people buying multiple properties and selling multiple properties in a 1031. If you're going to be selling multiple properties, that 45-day clock starts when the first one closes escrow. But that 45 days, essentially by the end of the 45 days, you need to know what you're going to buy. You need to tell us what you're going to buy, and you cannot change your mind after the 45 days. So what it really means is by the 45 days, you better be in a firm contract.
Mm-hmm. Okay. And next week, we're going to talk more about different kinds of exchanges, and there's really a lot of, might think of it as constraints, but there's really a lot of flexibility, isn't there?
Much more than you think.
We're talking with Ron Ricard with IPX 1031 Exchange Services, who about 1031 exchanges. We will come back after the next break and summarize what we've chatted about a little bit today and what we're going to get to cover next week. So come back with us in just a moment. This is KDOW 1220 AM, the Wall Street Business Network.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. We have Ron Ricard with us today from Investment Property Exchange Services, or IPX 1031, who's very knowledgeable and expert in this arena. A very, very important topic for all real estate investors, whether you've done one yet or not. If you're an investor or thinking about it, you probably will or certainly should do an exchange, and it's good to know about it up front, not after the fact. You can't. There's no whoops in exchanges, right?
Once escrow closes, it's too late.
Yeah, and that's on the first side, not just the replacement, right?
Yep, exactly.
Are all accommodators the same?
Well, we are not a heavily regulated industry. As a matter of fact, if you can post a $250,000 bond in California, you could be an intermediary. And and most people who do this job are great people and do a fantastic job. But remember, they are holding your funds, and so when you do work with companies, you do want to make sure that the money is secure and how that money is being secured. And working with somebody with that financial security is important because, like I said, they're holding maybe hundreds of thousands or sometimes millions of dollars of your money.
How large is IPX 1031?
We're the nation's largest 1031 company. We are part of a corporation called Fidelity National Financial. Locally, they owned a couple of title companies, Fidelity Title, Chicago Title. We work with all the title companies, but having the backing of a $6 billion publicly traded company makes a difference, because not only does it mean we have $100 million in bonding, $30 million in errors and omissions insurance, but there's also the backing of the billions of dollars they're holding that's protecting the title company, is also protecting the exchange company.
If I'm doing an exchange and I've sold one and there's money that goes to the accommodator, and my friend Kevin down the street has done one, does that money all go to the same account?
No. I don't know what every intermediary does, but for us, we open separate bank accounts for each of our clients so that everybody's money is segregated. You personally will get a bank statement from the bank that is showing your money is in there and how it's being held.
Ron, how do people get hold of you if they want more information about exchanges?
My toll-free number is 877-747-7875. Again, 877-747-7875. You can also go to our website at ipx1031.com. That's Investment Property Exchange, so ipx1031.com. There's a lot of information on that website. We also have our information in multiple languages, and there's a list of where you are, and click on that button, and either James or I or one of our great people that can be there to help you out.
What are the thanks for being with us today. What are some of the topics, aspects that we'll talk about next week for our listeners?
Well, the main thing I'm looking forward to talking about next week is why people do exchanges. I mean, you do not do it an exchange to defer taxes. You do an exchange because you want to buy something better, and how we define better and how clients do exchanges and what they exchange into is a great topic, because that's what is really going to be getting us to that next level of being that investor. And when you mentioned earlier that all investors need to know about 1031, we're going to talk about why that is.
That'll be great. Ron, thanks for being with us this week. Ron Ricard with IPX 1031 Exchange Services. Thanks for being with us. If you want some more information in general on real estate investing, go to TomWilsonProperties.com. You can request a weekly economic newsletter. You can request an article, white paper on how to select the best metro and product. And we also want you to tune in every day with my co-hosts Joe Cachera and Lori Graymont, Monday through Friday here on KDOW 1220 AM, the Wall Street Business Network. We have great real estate education information for you. Thanks for being with us this week, and we will see you next week with Ron back again.
You've been listening to Real Estate 360 on AM 1220 KDOW. For more information on today's program, visit RE360radio.com. That's RE360radio.com. AM 1220 KDOW.